All right, welcome back. There was some pretty good news yesterday that wasn't widely reported on. I didn't see it a lot of places, and it was that soft data type, the feelings, the squishy stuff, right? But it was still noteworthy. For the first time since 2024, which is only a year ago, inflation expectations tracked by the New York Fed survey of consumer expectations, well, they dropped across all three horizons in May. So the 1 year ahead inflation expectations, so what people thought inflation would be like in a year, that declined by 0.4% to 3.2%. In 3 years, that expectation declined by 0.2% to a round number of 3%. And if 5 years out, well, that inflation expectation declined by 0.1% to 2.6%, right? So the declines in median 1 and 3 year inflation expectations were broad-based across age, education, and income groups, right? It's amazing what a face-ripping rally from the April 8th lows can do to some of that soft sentiment, right? Now, we get CPI and PPI. Those are two inflation numbers this week. So we'll be keenly watching what those data points deliver. But my next guest is good at delivering, too. Please welcome to the show, Mr. Craig Bolanos. He's the co-founder and wealth advisor at VestGen Wealth Partners in Chicago. All right, that was not widely reported. A few places had it, but it goes to show you how quickly the soft data can change. Now, the hard data has been hanging in there, but the soft data has not been good. But boy, oh boy, suddenly they've turned their frown upside down. What say you?
Your phrases are the best. They turn their frowns upside down. Face-ripping rally. I think that's what you said. No, this is a good narrative, Scott. I feel like a broken record every time you invite me on your show. The soft landing remains intact. The hard data has yet to roll over anywhere. We had some weakness in manufacturing, but everything else looks good. And boy, oh boy, never make decisions based on sentiment, because sentiment is unreliable because it blows like the winds of change, fast and furious, especially for a guy like me in Chicago.
Okay, so we talked to a bunch of different people across the spectrum. We have guys on like Adam Johnson, who trades a big pot of money, all right? And so he's more of an investor that way. You look after people's retirement, their health care. You're looking to get their people, stay retired is really what you do. And so yours is more singularly based, right? It's bespoke to each individual customer. And so I was really interested to hear you say during all the calamity that we had in April and May that you didn't really see a ton of capitulation from your customers, and they weren't calling as much as, at least that's what I think you said. Maybe it wasn't quite right, but I kind of was talking about you earlier today and saying that, in this rally, a lot of the smart money got left behind. They got out and probably locked in some losses if they got out on April 6th, 7th, 8th, 9th, whenever they did. And it feels like today that the retail trade won because they stayed in and actually added. What say you?
The retail trader completely won. The retail trader has been conditioned to buy the dips ever since March of 2020, and it hasn't been wrong. Whether it was the yen carry trade last year, whether it was the year before when you had Silicon Bank and the other bank failures, whether it was some of the issues in 2022, or most recently, the Rose Garden speech in April. The bottom line is a buy the dips mentality has certainly been embraced by investors. And Scott, you also paraphrased it well. For VestGen clients, I think people were very steadfast, not complacent. I think they were steadfast, but that's because they're not just investors. They're people who are retired or getting retired, and they already had ample amounts of cash flow reserve accounts and other things to draw from, because the only person who loses when they invest is someone who is forced to sell stocks when prices temporarily decline. And if you don't put yourself in that position, you'll always end up a long-term winner.
Right. It's kind of like your house. The market might go up and it might go down. Unless you have to actually sell your house and it's in a down market, you're not going to be booking that loss. And if you stay in the market, and we talk about this with other people we have on the show, but generally speaking, and it's probably even more of an ironclad rule than that, the market does go from the lower left to the upper right, depending on your timing. You pretty much got a good chance, if you're disciplined and stay in, of doing well.
That's right. You have a great chance of doing well if you have a long-term perspective, but no one wants to do well. Everyone wants to do as best they can. You want to go from good to great, and that means you have to have well-curated plans to manage the income taxes, the estate, the cash flow modeling, and bring it back to inflation, Scott. It really is all about the year over year change. And you know what the good news is? With the year over year change hearkening and heading still and staying under 3, I think investors are going to be in a great position with today's starting yields in bonds and treasuries and other places to accomplish their needs and stay ahead of the silent killer, not hypertension, but inflation.
Yeah.
And that should allow a lot of people to sleep well at night.
So we've got the 10-year yield below 4.5% right now. The market doesn't like it around 5, but I say this. The economy, the hard data we talked about a little while ago, it's still doing pretty well. We've got decent growth. The productivity is hanging in there. If we have a strong-ish or a solid economy, I think we can handle 4.75 to 5% in that 10-year yield. What say you?
I think we can handle 475. I think anytime you get to 5, you're going to have some vigilantes out there and other people who are going to view, though, listen, America is still the risk-free asset. I don't care what anybody says. And 5% treasuries is a tantalizing number that is going to compete for equities at the margins.
Yes.
So anytime we're staying under 5, we're good. But if someone said, can we handle inflation being above 2, but less than 3? Yeah. Can we handle treasuries at or near 5? Yeah. I just hope that any of the growth scares we've had don't turn into real scares. And thus far, they haven't materialized. So stay data driven, everybody.
Yep.
Don't make decisions on sentiment, and you too can live on and prosper.
And just like that they do in Washington, we've got all the bantering back and forth, the rhetoric about this big, beautiful bill. But one thing that really they can't model is the growth, the productivity, what might come of some of these cuts, or what might spur on the market. But that's also hard for this business as well. We know all the negatives and what hurt us. We could, no deal with China or whatever. But we can't really put in there what AI is going to do to productivity, although we both probably would agree that it would be really good wind at our backs to help things go higher, right? So there are still some things out there, I think, that could help, even in the face of something that might be difficult.
I think the second half of 2025 and all of 2026 will remain an AI story, not just generative AI, but agentic AI. And it's going to be the earnings improvements you see in non-technology companies. Think financials, think healthcare, etc., who are adopting and leaning in to increase productivity per unit hour of labor. That's not just an inflation story. It's not just an earnings per share story. It's an everything story, and it's really playing out in real time while you and I are visiting right now.
Okay, so you use the word agentic, and I've heard that before. And if you could explain about it, that's where the machine starts to actually be able to teach itself to learn. Is that correct?
Yeah, I mean, generative AI is machine learning. Agentic AI is, again, think about all of, I call them bots, right? It's enhancing, not replacing, enhancing the human element by people having a co-pilot bot next to them operating on the computer to anticipate the tasks, to then execute the tasks. It's just about implementation quotient, a higher level of IQ.
Right.
And everyone's so fearful that we, the human element, are going to be replaced. Not yet, maybe in the warehouse, but here in services and communication, those who are leaning into and adopting technology are seeing tremendous economies of scale, even though we're only in the early innings.
That could be the key. That's going to be the key, I think. I think you're right. Craig, great to have you on. Thank you very much for coming on. Craig Bolanos, he's with VestGen Wealth Partners in Chicago.